Hi everyone, today we'll be going over accounts, October-November 2020, paper 3 question number 6. This is structured paper 3 which consists 6 questions, each of 25 marks, and we are also given a time limit of 3 hours. So we will be attempting to solve each question under 30 minutes. And this question number 6 is a part of section B which deals with cost and management accounting. Now without any further delay, let's get started. OT PLC makes one product and uses a standard costing system. Its standard costs and revenues for 1 month are based on the following information. So sales is 12,000 units at $15 each, and the per unit cost for direct materials is 0.25 kilos at 8 per kilo. Let's figure out the per unit direct material. That's just going to be the product of these two values, right? Because each unit would require 0.25 kilos and the per kilo rate is 8. So that's going to be 0.25 times 8, which results in our direct materials per unit to be 2. Similarly, we're given the direct labor, and each unit would require the direct labor of 30 minutes, and the rate per hour is 6. And let's convert these 30 minutes into hours, so that's just going to be half an hour, right? So 0.5 times the rate of 6, which gives the direct labor per unit to be 3. And we have variable overhead, which is $10 per direct labor hour. So this variable overhead is actually dependent on the total direct labor hour. Then we're also given our total fixed overhead to be 20,000 per month, and we're told that in March 2020 actual sales amounted to 12,500. So all these information are actually budgeted, which is the standard costing system. It is actually a budget that we prepare in order to make the manufacture process viable. Let's have a look at our first question. We need to state with regard to standard costing 2 advantages and 2 disadvantages. Alright, let's write it down. So the first advantage would be that it enables costs to be managed better, because since we've already predicted that future costs could be this numbers, then we are prepared for that cost, right? So this enables the cost to be managed better. Let's write it down. May enable costs to be managed better. Then the second advantage would be that this would facilitate in our variance analysis. So we can compare it with our actual number of units sold or actual costs incurred and then figure out the variances, right? Let's write it down. Facilitates variance analysis. Now we can move towards the disadvantages. So the very first disadvantage would be that these standard costing is actually based on estimates. So this is not the actual numbers, right? This can go wrong, this can go right. Let's write it down. Setting standards are based on estimates. And the second disadvantage is that calculating these standards is a difficult and time-consuming job. Let's write it down. Calculating the standards is a difficult and time-consuming job. This concludes the first part of this question. Now we can move towards the second one. We now need to prepare a budgeted income statement in respect of the master budget and the flex budget for March 2020. So the master budget would be in respect of the sales units or the budgeted sales units, whereas flex budget is the flexible budget that we prepare in order to incorporate the actual units sold. So let's have a look above. In this case, we'll be preparing our master budget on the basis of 12,000 units sold, whereas in case of the flex budget, we will incorporate the actual sales amount of 12,500 units. And since we're preparing the budgeted income statement, we first start with our revenues. So let's figure out the revenues for both our master budget as well as the flex budget. For master budget, that's just going to be total number of units times the per unit selling price. So that's just going to be 12,000 times 15, which results in the total revenue to be incorporated in our master budget to be 180,000. And for flex budget, that would be 12,500 units. So that's 12,500 units times the selling price per unit of 15, which results in the total revenue to be incorporated in our flex budget to be 187,500. Let's write these two values in our income statement. So we'll start with revenue. And we figured it out to be 180,000 for master budget and 187,500 for flex budget. So now we just need to subtract all of our costs and overheads. So the very first cost would be that of direct materials. Let's figure it out. Okay, I'm just going to write it right here. So the direct materials for our master budget would be based on 12,000 units. So that's just going to be 12,000 times the direct material cost per unit, which we figured out to be 2. This results in the direct material to be incorporated in our master budget to be 24,000. Let's repeat the same process, incorporating 12,500 units. So that's 12,500 times the direct material cost per unit 2, which results in the total direct materials to be incorporated in our flex budget to be 25,000. Let's substitute these two values into our statement. That's 24,000 for master budget and 25,000 for flex budget. And since this is an expense, I'm just going to write it down in a bracket indicating that this needs to be subtracted. Then our next cost would be that of direct labor. Let's figure it out. So direct labor for our master budget, that's just 12,000 units times the direct labor per unit of $3, which results in the total direct labor to be incorporated in our master budget to be 36,000. And for our flex budget, that is 12,500 units times the per unit direct labor cost of 3, which results in the total direct labor incorporated in our flex budget to be 37,500. Let's substitute these two values into our income statement. So that's 36,000 for master budget and 37,500 for flex budget. Then we are also given our variable overheads. Let's figure it out. And we are told that our variable overhead amounted to $10 per direct labor hour, which means that we now need to figure out the total direct labor hour based on 12,000 units and 12,500 units. So let's figure out the direct labor hour first. For 12,000 units, that's just going to be 12,000 times the direct labor per unit, or direct labor hour per unit, which is 30 minutes, right? So we can just multiply it with 30 minutes. Let's convert it to hours. So that's just going to be half an hour. So that's 0.5. So this gives the direct labor hour per 12,000 units to be 12,000 times 0.5, which results in 6,000. And then the variable overhead would be 10 per direct labor hour. And since we have 6,000 direct labor hour, that's just going to be 6,000 times 10, which results in the value of 60,000. So this is the variable overhead for our master budget. Let's figure it out for flex budget. That's 12,500 units. And each unit would require 0.5 direct labor hours. So that's 0.5, which gives the total direct labor hours to be 6,250. And then the variable overhead is 10 per direct labor hour. Since we have 6,250 direct labor hour, that's just going to be times 10, which gives the total variable overheads to be incorporated in our flex budget to be 6,250 times 10, which results in the value of 62,500. Let's substitute these two values into our income statement as well. That's 60,000 for master budget and 62,500 for flex budget. And finally, we have our fixed overheads. Let's have a look above. So the total fixed overhead is given to be 20,000 per month, and this does not change with our changes in units, which means that for 12,000 units the fixed overhead is going to be 20,000, and for 12,500 units it's also going to be 20,000. Let's write it down. So that's 20,000 for master budget as well as 20,000 for flex budget. Now we can easily figure out our profit. For master budget, that's just going to be the sum of these 5 values. That's 180,000 minus 24,000 minus 36,000 minus 60,000 minus 20,000, which results in the value of 40,000. And for flex budget, that's the sum of these 5 values. So that's 187,500 minus 25,000 minus 37,500 minus 62,500 minus 20,000, which results in the value of 42,500. Alright, this concludes our budgeted income statement as well as the second part of this question. Now we can move towards the third one. We're given additional information. The increase in sales units in March 2020 was the result of a special promotion where the selling price was reduced to 14.50. Okay, then we need to prepare a statement reconciling the budgeted sales revenue from the master budget with the total actual sales revenue for March 2020 using relevant variances. So we will start with our revenue from master budget. Let's have a look above. So the revenue from master budget is 180,000. And since we are preparing the statement reconciling using relevant variances, so in this case we're talking about sales, right? So the relevant variances would be that of sales volume variance, and sales price variance. And this would give our actual revenue. Okay, so first of all, let's figure out our sales volume variance. And we know that the actual sales was 12,500, whereas the budgeted sales was 12,000, which means that the actual sales was greater than budgeted sales. So that's going to be actual sales units minus budgeted sales units times the budgeted selling price per unit. So the actual sales unit was 12,500 and budgeted sales unit was 12,000, and our budgeted selling price was 15. So this is just 500 times 15, which results in our sales volume variance to be 7,500. And in this case, we can see that the actual sales unit is greater than the budgeted sales unit. So this is definitely a favorable condition because more units are being sold than what we actually anticipated. So this means that this sales volume variance is actually a favorable condition, which means that we need to add in order to figure out our actual revenue. So that's plus 7,500. Now let's figure out our sales price variance. And previously our budgeted sales price was 15 per unit, but we figured out that actually it was 14.50. And since the budgeted one is greater, that's going to be budgeted sales price per unit minus actual sales price per unit times the actual sales in units. So that's going to be budgeted sales price of 15 minus the actual sales price of 14.5 times the actual units sold, which is 12,500. So this is just going to be 0.5 times 12,500, which results in our sales price variance to be 6,250. And we can see that our budgeted sales price is actually greater than the actual selling price per unit, right? Which means that this is not actually a favorable condition because the selling price per unit, whatever we anticipated, it is lower than that value. So this is an adverse case, which means that we need to subtract this value. So that's going to be 6,250, but a negative value. So now we can figure out our actual revenue. That's just going to be 180,000 plus 7,500 minus 6,250, which results in the value of 181,250. So we can directly figure out our actual revenue by multiplying our actual sales price per unit with the actual units sold. Let's check it. So that's just going to be 12,500 times 14.50, which results in the value of 181,250, which is the value that we figured out from our statement, which means that our actual sales revenue is correct, which concludes the third part of this question. Now we can move towards the fourth one. We're given additional information. After the success of the promotion in March 2020, the company is considering reducing the selling price still further to 13. At this price, the company expects to sell 14,000 units a month. Now for the fourth part of this question, we need to name the variances which would be affected if the selling price was reduced to 13 per unit. Again, since we're considering the changes in selling price, the only variances that would be affected are the sales volume variance and sales price variance. Let's write it down. So that's sales volume variance and sales price variance. So now we need to figure out the values. Let's figure out the sales volume variance. So we know that our budgeted sales was 12,000 per unit, but we can see that for March 2020, we figured out the expected sales to be 14,000. So here the expected sales is higher, right? So that's just going to be the expected sales value minus our budgeted sales value times the budgeted selling price per unit. So that's going to be 14,000 for the month of March minus our budgeted or the standard of 12,000 times the selling price per unit, which was set at 15. So this is just 2,000 times 15, which results in our sales volume variance to be 30,000. Let's write it down. And we can see that our expected sales units is actually greater than what we anticipated, right? So this is actually a favorable condition because we are expecting that in March it would actually sell a higher number of units than what we anticipated previously. So this is a favorable condition. All right, now let's figure out our sales price variance. So we can see that previously the selling price per unit was 15, whereas now we are reducing it to 13 per unit. So that's just going to be the budgeted sales per unit minus the expected selling price per unit times the expected number of units sold. So that's going to be 15 minus 13 times the number of units, which is 14,000 per month. And that is just 2 times 14,000, which results in our sales price variance to be 28,000. Let's write it down. And we can see that our budgeted selling price per unit is greater than our expected selling price for the month of March, which means that the sales price per unit has decreased, which is not a favorable condition. This is actually an adverse condition. This concludes the fourth part of this question. Now we can move towards the fifth one. We need to advise the directors whether or not they should proceed with the suggested reduction in selling price to 13 a unit. We need to support our answer with calculations. So first of all, let's figure out the expected revenue if our total number of units sold is 14,000 and the selling price per unit is 13. That is just going to be 14,000 times the selling price per unit of 13, which results in the total sales revenue to be 182,000. And previously, our revenue from master budget was 180,000. So we can say that the total revenue will definitely increase. Let's write it down. So the reduction in selling price would increase total revenue. And the number of units sold has also increased, right? Previously, we anticipated it to be 12,000, but for the month of March, we are expecting it to be 14,000, which means that this would also increase our market share. Let's write it down. It would increase the market share and since we need to support our answer with calculations, let's figure out our contribution as well. So previously, okay, let's have a look above. Let's figure out the contribution in this particular case. So we have the selling price of 15 minus our direct cost, direct materials 2, and the direct labor 3, minus the variable overhead. And since our variable overhead is based on direct labor hour, and since we're trying to figure out our contribution per unit, we know that the direct labor per unit is 0.5 hours. So the variable overhead is just going to be 10 times 0.5. That's just 15 minus 5 minus 5, which results in the contribution per unit of 5. So previously we had the contribution of 5, but now we reduced our selling price to 13. All right, let's figure out the new contribution. That is just going to be 13 minus 2 minus 3 minus 5, which results in the contribution to be $3. So the contribution per unit has definitely reduced. Let's write it down. It would reduce contribution per unit from 5 per unit to 3 per unit. But we can see that there is still a positive contribution, right? So it would still make a positive contribution Now let's talk about the total contribution. So previously the number of units was 12,000 and the contribution per unit we figured it out to be 5, which gives our total contribution to be 12,000 times 5, which results in the value of 60,000. And for our new case, that's 14,000 units per month times the contribution per unit of $3, which results in the total contribution to be 14,000 times 3, which results in the value of 42,000. So we can say that the total contribution has definitely decreased. Let's write it down. It would reduce total contribution from 60,000 to 42,000, and hence the total profit would fall. So instead of reducing the selling price and expecting the total number of units to be sold to be increased, we could invest in some more advertising, right? Let's write it down as well. Other methods to increase sales, such as advertising, could be tried. And now, based on these factors, we need to advise the directors whether or not they should proceed with the suggested reduction in selling price to 13 a unit. So considering the fact that the total profit would decrease, I would advise the directors not to proceed with the suggested reduction. Let's write the decision clearly. The directors should not proceed with the suggested reduction in selling price to $13 per unit. Alright, this concludes the fifth part of this question as well as this entire question. If you found this video useful, make sure you like the video and leave a comment below. And make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.